Hi everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings before they put us on bed rest. Today we're diving into Editas Medicine's proxy statement, and it looks like they are asking shareholders to approve some big changes involving increasing shares and changes to their equity plans. Is this a sign of big plans or potential turbulence ahead? Let's decode it. Editas Medicine is gearing up for its annual shareholder meeting in May. They're asking for votes on everything from electing directors to approving executive pay, and also to increase the number of authorised shares. There are a few important changes to their compensation plan being voted on, which we will cover. First off, they need to elect 2 Class 3 directors. The nominees are Jessica Hopfield and David Scadden, both already serving on the board. They are recommended to remain on the board. A big part of this proxy statement is about corporate governance, which is how a company manages itself. Editas talks about engaging with stockholders, listening to their feedback, and making changes based on what they hear. They have regular chats with investors. The company lists a bunch of things they do to ensure good governance, like having independent directors, a compensation clawback policy, which allows the company to recover compensation if there are certain financial wrongdoings, and regular board evaluations to figure out what they can do better. All pretty standard stuff, but it's good to see they're paying attention. Twitter to the executive compensation discussion because it gets interesting. They lay out their compensation philosophy, which is to attract and keep talented executives, motivate them to hit goals, and reward them for both short-term and long-term performance. They want to make sure their pay is competitive in the biotech world. A key part of executive pay is performance-based cash bonuses. The CEO's bonus is 100% tied to how well the company does as a whole. Other executives' bonuses are 80% based on company performance and 20% on individual achievements. In early 2025, it was decided our corporate objectives were achieved at 110% of target. As a result, our named executive officers received an average payout under the annual performance-based cash bonus program of 110% of target. Seems pretty consistent and not too out of the ordinary. One major change is they are ditching a mix of stock options and restricted stock units and going all in on stock options. For the executives, performance-based restricted stock units are being dropped too. The Compensation Committee believes that this transition was appropriate in order to create momentum to drive long-term stockholder value and simplify the program for our employees. Let's take a quick look at the table summarizing executive compensation. It shows the compensation for the named executive officers, which are Gilmore O'Neill, the CEO, Eric Lucera, the former CFO, and Baisong Mei, the former Chief Medical Officer. Thrive and Taft in 2024, O'Neill made $5.1 million stock and option awards and a bonus $500 mat alajamant air. Eric Lucera made $1.8 million, which includes $482,600 for salary and option awards. Baisong Mei made $821,402. Now, there's an interesting table, one that Warren Buffett would probably look at. The pay versus performance table, which shows how the executive's pay lines up with the company's performance. It compares the CEO's compensation and the average of other named executive officers with total shareholder return and net loss. For each of the years indicated, we have not used any financial performance measures in our compensation table, and compensation table, and compensation table, and compensation actually paid, calculated in accordance with regulations. For detail on our executive compensation is shown using the total from the summary compensation table and compensation actually paid, calculated in accordance with regulations. For detail on our executive compensation in the proxy statement, Editas and other named executive officers with total shareholder return and net loss. For each of the years indicated, we have not used any financial performance measures in our compensation program or for comparison to any corporate goals. Our fixed compensation is shown using the total from the summary compensation table and compensation program. Looking at the numbers in terms of cap or compensation actually paid, to Gilmore O'Neill we see it going from $6.4 million in 2022 to $3.7 million in 2023, and then a negative $3 million in 2024. It appears that there were a lot of shares that did not vest for the CEO for a variety of reasons. There may have been underperformance leading to a smaller total compensation for the CEO, or perhaps with a rough year in the market. Equity grants may not be what they used to be in the near term. This is an advisory vote, meaning shareholders get to voice their opinion on whether they think the executives are being paid fairly, but the board isn't obligated to act on it. The board of directors recommends that stockholders vote to approve the compensation paid to our named executive officers. Now, this is a pretty major move, asking shareholders to approve an amendment to their restated certificate of incorporation. What this means is they want to increase the number of shares the company is authorized to issue. They want to go from 200 million to 395 million shares. The reason is that this will give them more flexibility for things like raising money, making acquisitions, and compensating employees with stock. Now, all those additional shares of stock would have rights identical to our currently outstanding common stock, meaning they have the same votes and control power. Also, they may be undercutting your voting power because there will be more shares that exist that aren't controlled by you. Your vote matters a bit less. The board did not authorize the authorized shares proposal with the intent that it be utilized as a type of anti-takeover device, that is a standard corporate formality line, which is included in almost all such filings. It also has the potential to be dilutive to current shareholders. The final big item is ratifying the appointment of Ernst & Young as their independent accounting firm for 2025. Nothing too surprising here. It's normal to make sure an important service provider continues to be well received. So what's the takeaway here? The company is pivoting towards maximizing shareholder value by focusing on their in vivo pipeline, which focuses on the development of therapeutics for more common illness that can deliver results for larger swathes of people. There are changes to executive compensation policies which should be kept an eye on to make sure they aren't overly diluting stock or providing easy compensation to managers. Overall, Editas Medicine appears to be in a transitional period with its pivot to in vivo product development. The upcoming shareholder vote on the increased number of shares will be telling. If approved, it could signal aggressive expansion plans, or it could simply be a precautionary measure for future needs. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, remember to hit that like button, subscribe for more deep dives, and let us know what companies you want us to decode next in the comments below.